little bit late today. I had to do a late restart on my computer and it took way longer to come back up than it should have. All right, so with that, let's get into what's going on. So what we're going to do today is talk a little bit about what's going on in Investors Observer, and then we have a market update, and then the rest is member-driven content. That is questions that were submitted ahead of time, questions that get submitted while I'm talking. If you have a question at any point, just throw it in the box. I've got two screens here, so I keep an eye on what questions are coming in so I can interrupt myself if somebody has a question about what I'm talking about at the moment. Otherwise, we'll run through them at the end. Yeah, so let's move on. So we don't actually have a lot of exciting announcement in Investors Observer. We are working on some stuff. We have some sort of things in the pipeline, as it were, and we're also doing this sort of, just technology stuff that you have to do that doesn't make an exciting announcement, but hopefully, the website's a little bit faster, a little more stable, things like that. So that's what we've been working on. I don't have a big announcement this time, but we do have some things we're working on. All right, so on to the market update. This is our regular chart. 1 year daily candles on the S&P 500. The peak here was about the middle of February. We'll look at some other charts in a minute where that middle of February gets more interesting. But yeah, we went down and spent some time below the 50-day moving average and then came back up, and we're still a little off the all-time high, but it's not too bad. So the S&P 500 versus the equal weight. This is 3 months. This big divergence here is again about the middle of February, about the time we set those highs on all the major indices. On the S&P and the Nasdaq. I guess the Dow is still setting new highs. And so again, the Russell. This is 6 months. The Russell versus the S&P, you can see it really takes off, and then it's really taken off again here lately, these last few days on a relative basis. XLK, which is technology, versus XLI, which is industrials, in blue. That February 18th date is about here, so you can see the divergence comes through, right? The industrials, whereas technology, not doing so well over that period. And here is the same technology ETF in white against financials in blue. It's interesting that the financials really started to take off sort of the end of January and had a little bit of a hiccup, but have generally just sort of kept on trucking higher, even while other things have fallen a little bit. All right, so what else is happening? We still have, sort of a virus-driven economy, although we're starting to really see a lot of light at the end of the tunnel at this point. Case rates are falling, vaccine production and actual distribution is ramping up. My guess is there's probably some number of people who are listening today who have had 1 or 2 doses of a vaccine, whereas my guess is there's probably very few, if any, who were in that boat just 3 weeks ago. And warmer weather is also on the way, which hopefully from an economic perspective should mean the return of things like outdoor dining and some other activities. Should help boost some spending and things like that a little bit. Stimulus is also on the way. The House passed the bill today. Biden should sign it pretty quickly. And that should also help, get the ball rolling in terms of recovery as the vaccine rollout and warmer weather also help. All those things should work together. A thing that we'll talk about sort of as a theme today, I guess, is that the fiscal response has been much bigger than after the great financial crisis, which should help speed the recovery. It just should be getting to a much better, getting started on a much better footing this time, as opposed to last time where we kind of did some things to stabilize the banks and a few other things, but didn't take the sort of, big, bold steps to really try to goose the economy which we're doing this time around. Yeah, inflation, people have been talking about a lot. We'll talk about that more on some subsequent slides. The consumer price index came in relatively low today. It's roughly in line with estimates, but I think some people were expecting it to be a lot higher. Some temporary inflation in some particular areas, especially around commodities, is going to, is kind of likely, I think, but that's that real inflation, if you will. And then, yeah, the other thing people have been talking about a lot recently is bond yields. The yield on the 10-year is still below 2%, which is historically very low and also doesn't suggest a lot of worries about inflation going forward. And really, the rising bond yields, I think, show confidence in the economy for reasons we'll talk about as we go on. All right, so first let's go through some of these other things. This is JP Morgan's spending tracker. The blue, purple, whatever color this line is the year ago, and then this greenish line, I guess, is relative to the pre-COVID trend. So we're starting to get into, a year ago is here now. We're already in the downswing in terms of a year ago from, we can't just go year ago because year ago is no longer pre-COVID. So that's why they've added this second line in. And you can see we're below the swing here. This big drop here is the ice storm in Texas and much of the rest of the country. It really put a whack on on spending, but it has bounced back quite a bit. All right, and then airlines. 3 weeks ago we were about here, I believe, and yeah, people are getting back to traveling. We had these other things before. This was the holidays, the Christmas and New Year's holiday. Here's Thanksgiving. Here's Labor Day. You can see all these things. They all sort of make sense just from when would you expect people to travel? February to March isn't really a when would you expect people to travel kind of thing. It's just, right? This is what getting back to normal looks like. It's a long grind to get back to where we were pre-pandemic. We're just at the point now where we're sort of semi-regularly doing more than 1 million passengers in a non-holiday week, 1 million passengers a day in a non-holiday week. But the moving average is now above 1 million, which hasn't happened for, other than these couple of, holiday weeks right around New Year's. So that's, from an economic standpoint, encouraging. You hope there isn't a bunch of new virus cases, but I think we're really, it's going to be a while, but it's still sort of on the way. It's on the way out. You can kind of see it in the data at this point. All right, so a lot of these questions sort of tie into that stuff. That's why I didn't spend as much time there as I would have otherwise. So Carolyn asked, she says, I'm new to investing. Can you explain why interest rates in the bond market affect the stock market? All right, so specifically this conversation recently has been around treasury bonds. And so there's sort of two worlds here, right? I don't know if you've ever, watched a presentation with a scientist where it's like, oh, well, in a world without friction, or some other thing where they start, taking away things, and so you can focus on one variable. Finance is a lot like that. And so, in the sort of theoretical world, treasuries are generally considered to be risk-free, right? Like if the whole world is denominated in dollars, there is, I guess some scenario where the dollar no longer works. But generally, if you're in the dollar economy, treasuries are the risk-free interest rate. Okay, so most other borrowing is linked to some part of the treasury yield curve, right? Like there's typically some relation between like 30-year mortgages and the 10-year because people refinance. So the average length of a mortgage is actually, even a 30-year mortgage is closer to 10 years than 30. But yeah, so if yields rise for treasury bonds, yields sort of rise for other borrowers as well. And as bonds are less volatile than stocks, they're generally considered to be safer. Okay, so when bond yields get very low, people tend to move into riskier assets because they try to get some return. The reason people invest is to try to get some return. And so if the return on bonds gets very low, you look for something else to try to get that return. Now, if in practical terms, what happens a lot of times is, right, so on any given day, a lot of times you see stocks are up, bonds are down, or the opposite. Now, if you looked at charts of, say, treasury prices and the stock market over the last 30 or 40 years, you'll see that they're both pretty high, historically speaking. So what happens though is when there's panics, okay, people start worrying about the economy and worrying about the stock market, flight to safety usually results in buying bonds, which pushes yields down. The opposite of that is money flowing out of bonds, which pushes yields higher. Okay, so when people are worried about safety, bond yields fall, but people still buy bonds. Okay, so that's money out of stocks into bonds. It pushes yields down. When people start thinking the economy is going to do better, that trend reverses. Okay, so one of the things we talked about a lot in 2020 was, the story stocks, right? Economic prospects weren't great, so, all the sort of, the classic stock market investments, right? Like railroads or Coca-Cola, the Warren Buffett kind of stuff doesn't really work when there's no prospect for economic growth. So people were focusing on exciting new things that offer opportunities, right? That offer growth opportunities without economic growth, right? The big promise of electric vehicles is, here's a company that hasn't sold a car yet, but in 10 years it could be General Motors. Okay, so right, people aren't lining up to buy cars in the middle of a pandemic when millions of people are just staying home all the time. So there's no real growth at General Motors. But if you have a company that could be the size of General Motors in 10 years, it's nothing now, that's an attractive. Pot stocks are the same thing, right? It's a very small industry. It's just starting out. If pot becomes, various pot products become parts of people's everyday lives, those stocks can grow even if the economy doesn't, right? It's places where there's a new thing, right? The SPACs are another thing, right? All those companies are the promise of incredible growth is really what those things are. Other technologies the same way. I mean, some of them are practical, right? Zoom, Peloton, those things are practical, but those are new categories, right? Those aren't stocks that just, they've been around for years and they go up when the economy goes up. They're not cyclical. They were sort of specific pandemic plays. And so where we're at now is that now that economic growth is back in the picture, other parts of the market have become more attractive, right? All the Warren Buffett stuff, right? The banks, your, Coca-Cola, that kind of stuff. Now that you see the market reopening, we've got stimulus bills coming. People are going to be able to go out and do things and spend that money that they're getting. Other parts of the economy look like they're going to grow, and some of these other things where maybe valuation has gotten stretched, maybe in the case of things like Zoom, it feels like people are probably going to back off, so that growth is probably going to be slower for the next year than it was for the past year. Those things look less attractive. So bond yields are going up and stocks are falling. Certainly some stocks are falling. There are some stocks that are doing pretty well. And they're happening at the same time, but they're happening at the same time. They're happening for the same reason, but I don't think the relationship is as cause and effect as a lot of the sort of reporting and discussion makes it seem. All right, and because this has been going on a lot, I sort of put together some other stuff here to talk about this to sort of, anyway. So there's been lots of narrative about those bond yields rising because of worries about inflation, and that's what's causing the high flyers from 2020 to fall. But I wanted to unpack that a little bit because it doesn't actually really make a lot of sense. Okay, so if you're a company that has borrowed a bunch of money to fund some growth, you've borrowed a certain number of dollars, right? So you borrowed $1 million or $1 billion, however many dollars it is. Okay, so what you owe is that number of dollars. So if you're selling products and inflation is happening, well, if you're selling products every day, you can raise the price every day if you need to, right? If you get one of those crazy Weimar, Zimbabwe inflation things that everybody worries about, you can raise the price every day and that's fine. But the $1 million, right? How much money you owe is the same amount of dollars. Okay, historically, inflation has been seen to be bad for lenders and good for borrowers. because you can raise the prices of things, increase the number of dollars you're bringing into their business to deal with the inflation, but your actual debts stay the same. Okay, now, so the debt becomes essentially easier to repay at that point. Now, higher interest rates, which come along with inflation, can make refinancing more expensive, but even so, the principal amount is less intimidating, right? So yeah, I'm not really buying the narrative that worries about inflation or pushing yields up and stocks down because if you're a leveraged company, a highly leveraged company in a growing industry, inflation is probably good for you because it means that your growth should outpace, right? You can grow faster than inflation. You can absolutely knock that debt out and it's no problem. So I'm just not buying that. And then, yeah, if you look at bond yields, the 10-year, I don't know where it closed today, but when I looked this up earlier, was a little over 1.5% annualized for 10 years. That's historically very low. And also, right, nobody's locking up money for 10 years at 1.5% interest if they think inflation is going to be higher than 1.5%. So the economy isn't actually, right, the bond market is not expecting inflation. It's just not. Okay, so it's not there. So if it isn't inflation, then what's happening? Essentially what's happening is what we talked about on the last slide. Confidence in the economy is unwinding some of that flight to safety. There's a lot of money that's been sitting in bonds and other safe assets since the market fell last year. Right? People went to safety and they just hung out there. And also right now, prospects for economic growth are making the other stocks more attractive, right? So we had those story stocks that were less attractive, or the story stocks were more attractive because nothing else looked good. But now the prospects for economic growth are right around the corner. All your, the sort of traditional economy things start to look more attractive, especially when you look at the valuations of some of the, Tesla and some of those things have just gotten to be super high. And then, yeah, again, right, we talked about it a second ago, but the inflation numbers this morning were pretty subdued. We're going to see some spikes in certain areas due to supply constraints, but a temporary increase in the price of, a couple of things here or there isn't inflation. Real inflation is actually going to require much lower unemployment, because inflation in a real sense is if you have too much money chasing too much resources, right? So with prices for everything go up, prices for something going up here, something going up there, that's prices for a few things going up. That's basic supply and demand happening as things happen. But with high unemployment, new supply can be brought on relatively cheaply. Okay, so if I'm making widgets and all of a sudden I can't keep up with demand for widgets, there's millions of unemployed people in this country. I can hire them relatively cheaply and make more make widgets faster. That's how that works. Where you start to get inflation is I have to go outbid somebody else who's trying to make a different kind of widget, right? When we have to outbid each other for workers to increase production, that's where you get inflation. What we're dealing with here is, shortages due to supply problems and things like that. And so, yeah, the other thing, and there's a great speech that the URLs are terrible. I would have included it here, but one of the Fed governors, Loretta Mester, I think her name is, gave a speech a couple weeks ago talking about sort of the new way the Fed is considering things. Because if you think about this, right, like inflation is really difficult with high level of unemployment. What that means is that all the people who are worried at this point about the economy getting too hot, what they're basically saying is too many people are going to find work, which when you have millions of people unemployed seems both very tone deaf and also probably bad for the economy. Worrying that too many people are going to be employed is not a problem that we've had in my lifetime. And yeah, the other thing is delays are preferable to price hikes for many businesses. I ordered a bicycle around Christmas time, and I just got it like 2 weeks ago. because a ton of people during the pandemic wanted bikes, factories were disrupted, things like that. And I asked the guy when I picked up the bike, like, are you still selling bikes super fast, or has it died down? And he said that they're taking orders for 2022. And they could not do that, right? They could sell every bike. They could just double or triple the price of bikes until they got rid of that backlog. But why would you do that? Price hikes can absolutely squash demand and balance out the supply and demand. But if people are willing to wait in line, why would you tell a bunch of customers to go away? It doesn't make any sense. So we're seeing a lot of delays and things like that, and they'll even out, right? Supply will ramp up, demand will go down. Those things will happen, but we're not seeing price hikes because people want to sell a lot of units. They don't want to necessarily maximize the price they can get for a unit. And especially in the sort of inner workings of the economy where we have business to business relationships, most of those companies want to have an online or an ongoing relationship. And so, if I have a supplier who really jerks the price around and tries to maximize his profit on every transaction, I'm going to be very likely to shop around the next time I need something, as opposed to, go to my normal guy. And so right now everything's competitive and it's a lot harder, and your margins probably go down over the long term if you do that kind of thing. All right, so we got a couple of speed round submissions today. This one wanted to know, he asked, what is the trend of gold prices? We're not really a commodity shop here. Gold can be a hedge against inflation, but it's really a no growth asset, right? It doesn't throw off dividends. It doesn't really grow. It doesn't really do anything. It just kind of sits there and hopefully gains value as the dollar goes down. But if you look at any kind of long-term chart, that's hasn't always been the case. So the trend of stocks in the esports space. So esports is kind of a broad and vague concept. I mean, it can mean potentially anything connected to video games. And then there are more recently, some smaller companies that have esports in the company name that it's hard to figure out what exactly they do. And then, you have companies like Sony that make PlayStations, or NVIDIA that make chips that go in gaming computers. All those broadly fit into the category of esports stocks. A lot of these sort of stock categories are very hard to define. And so, there are some decent investments there, and then there are some things that are pretty speculative and overvalued. I don't think esports is an area that defies traditional stock analysis. So I think, evaluate what you're looking at, and if it looks like a good investment, it's a good investment, whether it's esports or otherwise. And then, basically the same question about 5G stocks. And we've looked into this because it's a thing that people ask about a lot, and I know there's a lot of, trust me, I also get those emails about the hot 5G thing, and I can never figure out what those companies do. Obviously, there's chip making and things like that, but 5G is fundamentally just the next generation of cell phone service. We went to 3G, and then we had 4G, and now we're at 5G. And I haven't seen anything that really convinced me that 5G stocks are that different from 4G stocks, right? I mean, at a certain point, it's the phone company, the companies that own the towers, and then the companies that make the equipment. And there hasn't been anybody really that just came out of nowhere suddenly and started selling, cellular networking equipment that's, some hot startup. It's not really a thing. The thing that will happen with 5G is, and I'm not an engineer, but to get those higher bandwidths and things like that, you need more towers essentially, right? So it's one, the rollout to rural areas is going to be slower because you need more towers closer together. And two, you will, yeah, you're going to sell more antennas, right? So however many antennas and pieces of equipment you had to sell for 4G, you're going to need more than that for 5G. So there's absolutely some growth there. And then where I think 5G gets interesting is what people do on top of it if you have higher bandwidth available to people and other devices that are just kind of moving around. But I couldn't tell you what that is at this point. And so, yeah, again, right, like what is a 5G stock? It's, it might be Verizon, it might be Cisco, it might be, some REIT. They really sort of defy those sorts of categorizations. All right, what is the trend for oil stocks? Short term, demand is likely to increase, right? Oil is 100% one of those growing economy sort of things, right? We talked for a lot of last year about how oil was depressed because oil is functionally a transportation fuel, and if you got fewer people moving around, you're just going to sell less oil. You get things reopening, you get more people moving around, especially you get some pin-up demand and some stimulus checks. Some people are going to take some vacations this year. You're going to see higher oil prices. Long term, though, I think the trend is pretty clear. I was looking at this earlier. Let me find where there we go. So yeah, you can look at a long-term chart of Exxon. Just go look at the all-time chart. The peak is in 2014. Chevron, the same thing. Peak is in 2014. And even, if you look at the smaller, some of the onshore players, the peak is in a little bit of a different place, but we're kind of past it at this point. EOG was 2018, right? So shale was a big thing in the U.S. in 2018. So the shale guys peaked later, but still, that's 2.5, 3 years ago. I don't want to say that Exxon will never get back to that place again, but it seems unlikely that Exxon is going to retain its position or regain its position as the world's largest corporation, which it was for a long time. So yeah, I think they'll probably do pretty well this year and maybe next year, but yeah, long term, I think the oil industry is becoming less important to the economy. Index fund symbols for S&P 500. So SPX, if you're just looking up the S&P 500, it's SPX. Index funds are things like SPY is the biggest one. I think VOO is the Vanguard version. There's a couple others, but they're all basically the same because that's the point of an S&P 500 index fund. What are symbols when gold spot prices up and down? So commodity and index symbols can vary across platforms. Some places you need to look up a future symbol. Some places it's something else. And the symbols are the same regardless of trading direction. So that's, yeah. All right. And then this person whose name I won't attempt because I know I'm not going to get it right. Said, do I think this is a good time to pick up renewable energy stocks or have we seen the bottom yet? I think it really depends on your holding period, right? I mean, calling tops and bottoms is hard. In the same way that, maybe Exxon isn't a buy and hold forever stock at this point, but it might work out well for, a while. If you're talking about the next 6 months, I don't know, things ran pretty far between the election and now. But, if you're talking a period of years, yes, pullbacks can be attractive opportunities. Is the semiconductor shortage going to continue for 2021? It certainly seems like it. I don't think people are going to suddenly start making things without chips in them. That just seems weird. So I think you'll see, some of those the same things I was talking about with bicycles, basically, right? You'll see some delays and things like that. Maybe some prices will go up a little bit here and there. And then for the second part of this question about the effect on EV stocks, specifically General Motors, which, by the way, kudos to you for seeing GM as an electric vehicle stock. Right. sort of the same thing I was saying about 5G and esports. If you're an automaker at this point, you're an electric vehicle maker. That's just where that is. And so, yeah, but it applies to a lot of other industries as well. One other thing I wanted to look at here was, let's go look at something like Micron technology, which makes computer memory. So there are absolutely specialized semiconductors that do this or that, but we're talking about RAM here and then flash memory. So this is just memory. Okay, memory is memory. It's pretty fungible. You can do a bunch of different things with it, but the things you can do with it are all the same. Obviously, we can sort of discount the .com boom here, but even if you look at like the last 5 years, it goes up and down and up and down and up and down. And so memory is essentially a commodity. And so what happens is the price goes up and they increase production, and then the price goes down because production came up, and then that cycle just repeats over and over and over again. So if you look at something like NVIDIA, which is another chip maker, but they make a different kind of chip, you get a really different looking chart over the last 5 years. Because they make different chips. So there's been the demand dynamics are different there. All right, and then rising rates, inflation. What do we expect from bank earnings this April? Yeah, so back to the previous comments about economic growth, banks are absolutely one of those, growing economy, growing earnings sorts of things. Now, banks are interesting because they also make money from market volatility. So there's been some of that recently. The SPAC boom is probably good for your banks that have equity underwriting desks. So your regional bank probably isn't underwriting a lot of SPAC IPOs, but JP Morgan, for example, absolutely probably doing okay there. And then when the economy is growing, banks do well. Now you can argue, and I'm sure you can go find the papers about banks do well when the yield curve is steep. But also when the yield curve is steep, it means future expectations are higher. So that means the economy is growing. So again, right, chicken egg. But yeah, when the economy is growing, banks tend to do well. So I expect that they will be okay. You'll probably see write-off of, not write-offs, releases from loan losses and things like that. All right, so Charles said he's interested in out-of-the-money long puts against Tesla that would assume it's a bubble, and then a strategy for that. So yeah, essentially anytime you want to bet with options, whether you're buying calls to bet something will go up or buying puts to bet that something will go down, options contracts are like insurance policies, and so you can structure those trades. The variables are very similar to what you're doing with an insurance contract if you're buying insurance, right? So in the money, the options contracts are more expensive, which is functionally like a high premium on your insurance, right? But they offer low to no deductible, right? You need less of what you're insuring against to see some return. Okay, so this is your, top of the line plan. Anything that you're willing to submit a claim for, they'll pay it. That's your in the money options contracts. Whereas the out of the money contracts are cheaper, but deductibles are higher, right? So you can buy contracts that are way out of the money for a nickel, but you need the stock to move a lot for those to pay off. Lower premiums, but higher deductibles, right? You need more of what you're insuring against to see some return. And so really at that point, it depends on when you think this fall is coming from Tesla. I actually wrote an article recently, you can still find it on our website, about essentially why I'm not short Tesla. I don't think the valuation makes a lot of sense, to be honest. But for the same reason, I don't really get involved in the gold market. There are too many people in that market that think things work differently than I do. Right? I would not get on an airplane with a pilot who has alternative ideas about physics, for example. Okay? Like, he might be right, he might be wrong. I don't know. I'm just not going to get on the plane. Okay, and that's how I feel about Tesla and gold, right? Like I have opinions about how they should be priced, but there are enough people in those markets who aren't trading on, in the case of gold, the fundamentals of how commodities tend to work, or in the case of Tesla, the fundamentals of how security analysis tends to work. There are enough people trading those in that way that it just doesn't make a ton of sense for me to get involved in those markets because they don't behave the way I would expect them to. All right, when do you give up on a losing option? For example, if you have 2 weeks till it expires and no way it will get back to the strike price, but it's still up 10%, do you sell and take whatever you can make? So, yeah, this is a little bit interesting to me because it says losing options, but also says still up 10%. So yeah, I don't know. In my experience, if you're up 10%, you're winning. But it's possible I don't entirely understand the question here. And the thing, whether it's options or stocks or whatever, there are traps you can fall into. Okay, beware of sunk costs, which is, okay, well, I'm already down this much, I need to get it back. In some sense, that's true, but you don't have to get it back from that stock or that trade, right? Like, wanting it harder isn't going to make the stock go up. Sometimes it's better to just walk away and find something else. And then the other thing is, I don't know how many of you have done any sort of short-term trading, but a lot of times you have something that's starting to look bad, or maybe it's starting to look good and you're thinking about getting in. There's a real tendency to just sort of stare at the chart, right? Like, oh, well, if I can get one more candle painted on there, that'll tell me the story and I'll know what to do. Well, at a certain point, one more candle turns into one more and then one more, and now you're just staring at charts all day and not trading. So this is why people develop rules-based systems. I tend to try not to have rules because I don't think a hard and fast rule works either, because if there was a set of rules that guaranteed trading success, that's what everybody would do. And then if everybody tried to do the same thing, the market breaks, right? You need sellers and buyers. Not everybody can follow the same rules. Markets don't work that way. But those are things I try to keep in mind when I'm trading is, sometimes it's just no good and you made a mistake and it's better to go look for something else somewhere else. And also, sometimes one more candle does clarify the picture. Sometimes it just muddies it further. And there comes a point where you have to kind of fish or cut bait. And then, the other thing is there's no need to hold options until expiration, right? So if you got 2 weeks left, you have 2 weeks till it comes back. But it sounds like you're it sounds like you're a ways away, you're a ways out of the money if you're waiting for the stock to get back to the strike price. So in those last 2 weeks, that option is going to start to bleed time value relatively quickly. And so there's absolutely no reason to hold it to expiration to hope it, comes back to something. If it's up 10%, take 10% and go find something else. All right, so I believe this is from Kevin. Yeah, he's interested in the investors' keyhole trades. He wants to know how to calculate the risk and reward. Right, obviously the percent return is interesting. It's tempting to take the higher percent returns. And so, so how do you compare these things? And then will they always be bull put credit spreads, or will that change? All right, so the first part of that is to get back to the insurance example I talked about a little bit earlier, right? Insurance all basically gets priced the same relative to risk, right? So obviously if you have a big house on the beach, it's very valuable. And so you're going to pay a higher premium than a smaller house on the beach. But for the same risk, the price is going to be basically the same. Okay, and so what that means is all other things being equal, right? So if you have the same, the same length of trade basically, and the same, the same amount of downside protection, this trades the same amount out of the money, the return is essentially a measure of the risk, right? So a higher return probably has a higher risk. And honestly, even if you factor in the moneyness, how far in or out of the money is, a 10% return at 20% out of the money is still probably riskier than a 5% return at 10% out of the money, because there's a reason the options are priced like that. Options are priced based on risk. And so something that's way, way out of the money and there's no chance of it being assigned, there's just no premium there and you can't trade it. So yeah, return is as good a measure of risk as anything, really, just because that's how that works. And then, yeah, so the second part, we do mix a bear call spread in occasionally, but even in rough markets, we usually can find things where the bullish strategy works. And we sort of prefer that because stocks tend to go up more than they go down. And so with a thing like this where you're just doing a lot of trades, it makes sense to sort of try to have as many pieces like that you can in your favor as you can. All right, so I'm not sure this was David, but the question was, I think it was actually Carlos, wanted to know about Airbnb. So we'll go look at that on the website also here. All right, so specifically, I think he really was sort of wondering about it as a reopening play, which it's interesting because I don't follow Airbnb super closely, but what I have read is that a lot of people started during the pandemic using Airbnb because, right, you can avoid a crowd that way. It's a lot of times a single dwelling unit, right? It's not like a hotel where there's a whole staff and a bunch of other people coming and going. So people who were traveling during the pandemic were using Airbnb. I don't know that necessarily, I think the number of travelers may shift. There may be more people who list now. I think I know a guy who lists his house on Airbnb occasionally, but he does it when he's planning to travel for the weekend. So if he wasn't traveling, his house isn't listed on Airbnb, so nobody's renting it. So Airbnb is not, making money for renting that house. So yeah, it's hard to know where something like Airbnb fits as a reopening play, just because it ended up working to some degree as a pandemic play. And so it's really hard to analyze it on the reopening side, because I feel like it probably loses some of that pandemic stuff as people go back to work, but it might gain some stuff on the other side. All right, so Angela asked, is there a market crash? If there is a market crash or correction, would I recommend a hold and see approach for tech stocks or sell at a loss? Again, right, it depends on your time horizon. I try not to recommend selling at a loss whenever possible. Things do tend to bounce back if you wait long enough. Obviously there are, frauds and other things, right? We talked about long-term decline and things like Exxon. So that's, duration isn't a solution for all of your problems. But yeah, I mean, the way to get around, a lot of concerns about having a bunch of tech stocks if a crash happens is to keep a diverse portfolio. And what that means is essentially sell some winners and buy some losers, right? So if you've been adjusting your portfolio during this rally, you've been taking profits on tech stocks as they go up and buying, some of the regular reopening stocks along the way. And now you're in a pretty good position where the reopening stocks are going up, the tech stocks are going down, and you're fine, right? Like if every stock in your portfolio is going up every day, it means there's a pretty high likelihood that there's going to come a day where every stock in your portfolio goes down. So if you have a nice, broadly diversified portfolio, you should be able to have, some things go up today, some things go down today. Overall, the sort of course of things is upward on a net basis. And you certainly don't want something that goes down every day just to balance out the things that go up every day, right? A stock that goes down every day isn't a stock you need to hold. But yeah, if you're worried about having too many tech stocks, really the time to fix that is sort of before the crash or correction. So Jay says, what do I think of meme stocks like GameStop? It's a video game. It's not. It's not investable as far as I'm concerned. It seems like fun if you're into that kind of thing. The swings are too big. Yeah, I'm not playing this game. The swings are too big. It doesn't make any sense. I don't know that the stock was fairly valued at less than $5 at the end of last year. It seems to almost certainly not be correctly valued at 265. It's not a game I'm interested in playing. One thing I will say, and I think as people notice this, it probably stops working to some degree. But if you look at this chart here, a lot of the big moves have come overnight. So it's strategy that seems like it might work in terms of, you go from here to here, here to here, here to here, obviously less so. But then when we start to go back up again, buying at the end of the day, there's a lot of red candles on this chart, even when the stock is going up. So buying at the end of the day might make more, and holding overnight and seeing what tomorrow brings may make more sense than buying in the morning when everybody else is selling. But that's just a thing that looks like it might make sense. I haven't back tested it. I'm not interested in playing this game. But yeah, all right. All right, so Raphael says, I noticed that many of the covered calls on the daily morning email are very bullish. For example, Foot Locker looks great for directional trade, like a credit spread. On top of that, we sell calls very close to the price, so we're begging to get called away. I thought when you sell the covered call, you want to sell out of the money so that you can also get paid on the sale of the stock. It appears from Foot Locker we're happy with the premium received. I'd like to better understand the strategies. Is it strictly income generation? Do we ever do directional trades? So to get back to the directional, yeah, it's hard to know what directional means in that case. We're not just buying or selling options or doing out of the money debit spreads. We may add those things in the future, but we're not doing it right now. And then, yeah, we generally structure these trades to collect premium. That is the strategy on all of our covered calls and the diagonal spreads, right? Sometimes they're a little bit out of the money, sometimes they're a little bit in the money, but mostly what we're trying to do is harvest the premium. And that is because, yeah, predicting the future is hard, right? So I can try to guess which way a stock is going to go and make some money from that, and that works. People do that. But yeah, essentially all of this call selling, what it's doing is your short time value. Okay, and I don't know what the stock is going to do tomorrow, but I'm pretty sure tomorrow is going to happen, and then there'll be a tomorrow after that and one after that. And if I'm short time value, I make a little money every day doing that. Now, sure, the stock can go down and it can work out poorly. We try to pick good stocks that you wouldn't mind owning most of the time for these. But that is it's absolutely, yeah. It's not buying GameStop and riding it from $5 to $400. But it's also not riding GameStop from 400 down to 5, or 400 down to 50 even, whatever. It's a strategy with much less volatile results. All right, so TT said, would we expect industrials, basic materials, energy, and financials to do better this year? So interesting. Some of this has already sort of started to happen. And so you wonder how far things can go. If we looked at the Exxon chart, not for 5 years, but say for the past year, right? Exxon's been going up for a while now, right? It's almost doubled from October. What else do I have here? Right, banks. Just use JP Morgan as an example. Look at the last year. Again, right, like it's really started to move upwards. So I do think these things benefit from a growing economy. I think we're probably going to see a continued rotation back here. We're not necessarily getting in at the start of a turn, but absolutely, if you look at, say, the sectors and industries, things with the highest overall surge, even if we just look at charts in the short term, right? Technology manages to be at 3 after yesterday, but it was at the bottom earlier this week over in sentiment. Technology is still pretty low as far as sentiment goes, which is our relatively short-term indicator. Analysts love healthcare and technology because they tend to offer opportunities for growth that are above, sort of economic growth. But right behind those two, you got basic materials, industrials, and then financials is a little bit lower. But yeah, I certainly think those are much more attractive in March of 2021 than they were in March of 2020. Michael says, is our software part of the membership? Yeah, Michael, we don't have any software other than just what is on the website. So yeah, there's no software to download or install. It's just just what's on the website. So if you can get on the website, you've got the whole thing. All right, so I have a question about JMIA. Yeah, I've seen the ticker. I'm not super familiar with the stock. It doesn't. Yeah, I mean, you'd have to have some insight into what's going on here a little more than what I have at my fingertips. Analysts don't seem to be super excited about it. Even given what I said, that they tend to love technology and healthcare beyond other things altogether. So that's maybe a little bit concerning. Also, the company doesn't make any money. I'd be interested in knowing what exactly their plan for turning that around are before I started buying more of it. Yeah, also assuming. Yes, the other thing you have to deal with here is this company does business, it looks like primarily, if not exclusively, overseas. And so now you have some currency risk in the sense of like, well, if the dollar gets super strong or super weak, that can move the stock price as much as what the actual company is doing. All right, so Terry wanted to know, is there a way to figure out how to get it on the start of an upward turn? Not a good one, Terry. I mean, yeah, what I have heard from people who were, who've done a lot of swing trading and things like that is, a good performance is catching 30% of a move. Okay, so you get in a third of the way after it makes a turn and still, 30% before the top. Obviously, you don't know when the top is coming, so there won't be a light that flashes that says it's 30% to the top, sell now. But that is considered to be good performance because, yeah, calling tops and bottoms is very difficult. Now, with broad cyclical things like this, it's less hard. Right? I mean, right? People weren't going to stay home forever. Right, so especially as vaccines started to get improved, I think we looked at. Let's go back to that Exxon. Come on, chart. See if this one loads faster. Yeah. Anyway, the bottom for oil stocks was in October, which is right when there started to be, I don't think anything had been approved yet, but there started to be some optimism about vaccines getting improved. You know, if you can be, go back here. Yeah, toward the end of October, beginning of November. If you can be forward thinking about things, you can, sort of predict some of those turns occasionally, in a broad cyclical sort of sense. All right, so we have a question about Clsk Trade from earlier this week. Let's see, Tuesday, that would be yesterday. Clean Spark. All right, so yeah, I mean, this is just one of our IK trades. Yeah, buy the 15, sell the 17.50 for a 40-cent credit. Looks like the stock is up today. I'm not sure. Yeah, don't really have much to say. It looks like it's doing fine. All right, let's see here. All right, so there's a question about EHang, which I don't remember the ticker. Oh, there we go. I'm kind of familiar with this company. Yeah, so this is very much the kind of thing that I was talking about earlier in terms of story stock, right? Like autonomous aerial vehicle. That mostly means drones. But yeah, if we look at the performance over the last year, I mean, yeah, just looking at the chart, I mean, it looks, yeah, more like a game stock than anything else. But yeah, it loses a lot of money. And I don't have a good way to evaluate things like this, right? I mean, I think, I don't know if you're familiar with the Nikola story, but and Nikola was an electric car company that went public through a SPAC merger, and it doesn't seem like they've actually made any cars. I don't have a good way to evaluate these companies. It may or may not work. It seems like, let's see here. 2 billion market cap isn't huge. Let's go look here at the stock screener. Sure. So a thing to do sometimes is just go look at companies and see what seems, right? What's a similar company? And just in terms of size. So, United Natural Foods. Or if you could find one that was in the same industry, that helps, right? So like, yeah. All right, I don't see a whole lot here that jumps out at me. Yeah, I don't have a lot to say about it. I have some questions about, right, so it uses drones to put out high-rise fires, air taxi, and product delivery. My thought on that is I don't think it does any of those things. I think they may be saying we have the, we potentially have the capability to do these things in the future. I would treat it like a biotech stock, basically, right? It's very speculative. It may or may not pan out. There's no, right, like it's a technology that exists. It's not the sort of thing that necessarily is guaranteed, because it's not the sort of thing where they have probably cornered any sort of market, right? Like somebody else could build an air taxi. I don't know why this company has any great advantage there. right, so I think that's most of the questions. I don't see anything else that's begging to be answered. Sorry I didn't get to all the stock analysis necessarily. Poke around on the website by all means. If you have something you have a question about, you can hit the help button and send us a question, and I'll try to help you out there. But yeah, thank you all for coming. This session was recorded, so we'll be sending out that recording tomorrow. Sometime we'll post on the website as YouTube videos so you can watch. Anyway, thank you for coming. Thank you for subscribing to Investors Observer. And yeah, I'll talk to you soon. Bye.